1971, Akron, Ohio. A factory supervisor. 11 years in, decent wage, mortgage, car. He believes hard work converts income into something permanent, something inherited. He's not lazy, not uninformed. He's simply inside a system that has not yet revealed its rules. Those rules, once visible, feel less like economics and more like architecture. Deliberately designed and quietly enforced. This is not about motivation or mindset. This is a forensic examination of why the wage has a ceiling built into it. One most people never see until their most productive decades are already spent inside it. Part 1. What people think is happening. There's a story most working people carry with them. Nobody invented it to deceive you. It emerged organically, reinforced by school systems, parental advice, and the culture of every industrialized nation across the 20th century. The story goes like this. Work hard. Earn a good salary. Save what you can. Those savings compound. And eventually, you arrive at financial security. Perhaps even wealth. It is a clean, linear narrative, and it contains just enough truth to be persuasive. The truth it contains is this. For a specific window of history, roughly from the end of World War II through the early 1970s, something resembling that story actually worked. Wages rose. Fringe benefits grew. Union density was high. Corporations shared productivity gains with their workers. A single factory income could sustain a household, fund a retirement, and send children to university. People who lived through that era absorbed a fundamental assumption, that labor income and wealth creation were part of the same process. They are not. They never fully were. And since approximately 1980, the gap between the two has been widening, passed invisibly from one generation to the next, like a structural flaw in a building that looks solid from the outside. Part 2. What is actually happening? Begin with a distinction that sounds simple but contains almost everything. Salary is earned. Assets are owned. And to get rich, you need ownership of assets, whose value appreciates over time, assets that generate returns whether or not you show up to work tomorrow. Not earned, owned. This is not semantic. It is the central mechanical difference between income and wealth, and it is the distinction that the wage narrative systematically obscures. When you work for salary, you exchange your time for money. The exchange completes at the end of the pay period. The money arrives. The time does not return. The employer retains the productive output, the intellectual property, the compounding, organizational value your labor helped build. You receive a deposit, and next month you sell your time again. This is not exploitation in any dramatic sense. It is simply the mechanical definition of wage labor. You sell a perishable asset, your time, for a liquid asset, cash. The problem is that cash, unlike equity, does not compound on its own. It must be actively redirected into something that does. And most wages, by the time they have covered a mortgage, car payments, child tuition, groceries, and medical expenses, do not have enough residual mass to redirect meaningfully. That is not a moral failure. That is a mathematical constraint. Part 3. The hidden mechanism. Wealth, the value of a household's property and financial assets, minus the value of its debts, is much more highly concentrated than income. People treat income inequality and wealth inequality as the same phenomenon at different intensities. They are not the same phenomenon. They are structurally different animals. Income inequality describes the gap between what people earn in a given year. Wealth inequality describes the gap between what people own across their entire lifetimes. Federal Reserve data show that the least wealthy 50% of U.S. households hold less than 4% of the nation's wealth, while the households with wealth in the top 10% hold over 2/3. Think about what that means. Half of all American households, millions of working families, many of whom earn what any reasonable person would call a middle-class income, collectively own less than 4% of the nation's total wealth. Wealthier households tend to benefit most from bull markets, because a larger share of their wealth is invested in stocks and other securities. Middle-income households, on the other hand, tend to have their wealth tied up in their homes. This single observation explains more about wealth divergence than almost any other data point in the literature. A house is an asset, that is true, but a house is a leveraged, illiquid, maintenance-intensive asset that generates no income unless rented, cannot be partially liquidated, and typically appreciates at rates that barely outpace inflation once you subtract transaction costs, property taxes, insurance, and structural maintenance. Business equity and publicly traded shares are fundamentally different instruments. They generate dividends. They compound. They can be fractionally liquidated. They receive favorable tax treatment across generations. And they benefit from every dollar of productivity growth that flows through the economy, including the productivity generated by wage workers. That is the hidden mechanism. The worker generates productivity. The owner captures its compounding value. The worker receives a wage that expires at the end of each pay period. The owner receives an asset that appreciates while they sleep. Part 4. The historical precedent. This is not a new problem. It is a recurring one. A century ago, the 1920s, wealth concentration in the United States reached levels that look almost identical to where we sit today. The top fraction of society owned the productive assets of the nation. Everyone else owned their labor. Then came the Depression, the New Deal, the Second World War. And in the post-war decades, something historically unusual occurred: wealth democratization. The GI Bill created mass home ownership. Labor unions extracted defined benefit pensions from corporations. Social Security provided a floor. Progressive taxation compressed the top of the distribution. For roughly 30 years, the wage earner and the asset owner lived in something closer to the same economy. Then, the architecture changed. The 1970s brought stagflation, oil shocks, and the collapse of the Bretton Woods monetary system. The 1980s brought deregulation, declining union density, and the opening of global labor markets that suppressed wage growth for decades. Defined benefit pensions, instruments that had given ordinary workers genuine equity-style returns without equity risk, were systematically replaced with defined contribution plans, transferring investment risk entirely to individual workers who had neither the time nor the expertise to manage it. From 1981 to 1990, the change in mean family income ranged from a loss of 0.1% annually for families in the lowest quintile to a gain of 2.1% annually for families in the highest quintile. The top 5% of families fared even better. Their income increased at 3.2% annually. Thus, the 1980s marked the beginning of a long and steady rise in income inequality. The concentration of annual income at the very top of the distribution rose to levels last seen nearly a century ago during the Roaring Twenties. The pattern had returned, as it always does when the structural conditions that briefly disrupted it are removed. Part 5. The mechanism of divergence in real time. Let us make this concrete with numbers, because numbers are harder to dismiss than arguments. From 1970 to 2018, the share of aggregate income going to middle-class households fell from 62% to 43%. Over the same period, the share held by upper-income households increased from 29% to 48%. This is not a marginal shift. This is a structural reallocation. The middle class did not lose ground because of individual decisions. It lost ground because the architecture of the system, the tax code, the labor market structure, the composition of retirement instruments, was rebuilt in a direction that consistently favored ownership over labor. The 50% gains in middle-class median income were far outpaced by the upper-income tier, which saw gains of 69% in the same economy over the same time period, experiencing the same aggregate growth. The difference was not productivity. The difference was not effort. The difference was asset class. Then came 2008, and this is where the autopsy becomes surgical. From 2007 to 2010, median net worth declined by an astonishing 39% in 3 years. Nearly 40% of the typical American household's wealth gone in 3 years. And here's the mechanism beneath the collapse. Middle-class households were concentrated in one asset, their home. That home was purchased with significant leverage, a mortgage representing 4, 5, 6 times annual income. When housing prices fell, the leverage worked in reverse. Equity disappeared, somewhat negative. And unlike the wealthy, who held diversified equity portfolios that recovered as central banks flooded the financial system with liquidity, the middle-class household had nothing left to recover with. In the United States, the share of household wealth owned by the top 1% of the population grew from 29.9% in 1989 to 35.5% in 2013. Meanwhile, the share of wealth owned by the bottom 50% of the population shrunk from 3.0% to 1.1% during the same period. The same crisis. Two entirely different outcomes, determined not by character, not by intelligence, not by work ethic, but by asset class. Part 6. The people who escaped. Well, now the question this analysis inevitably raises: if the wage is structurally limited as a wealth creation instrument, how do some ordinary paid people escape the trap? Because some do. This is documented. It is real. The ordinary paid people who built significant wealth share a pattern that is almost mechanical in its consistency. At some point, often after years inside the wage system, they identified the structural difference between income and wealth and made a deliberate, sustained decision to redirect a portion of their labor income into ownership. Sometimes this was equity in the company they worked for. Sometimes it was shares purchased systematically through market cycles. Sometimes it was a side business that began small and compounded. Sometimes it was real estate, but income-producing real estate, not simply a primary residence. The specific instrument varied. The structural logic was identical in every case. Labor income was converted, systematically and over time, into an asset that generated returns, independent of whether the person continued showing up. This is the escape mechanism. It is not secret. It is documented exhaustively. Wealthier households benefit most from bull markets because a larger share of their wealth is invested in stocks and other securities. According to Gallup, 87% of Americans who own stocks are adults living in households earning $100,000 or more. This tells you something critical. Equity ownership is not merely a wealth outcome. It is also a function of income level, of whether a household has enough margin above its fixed obligations to begin converting labor income into ownership. And that margin, for the majority of wage-earning households, is structurally thin. The irony is almost perfect. The safest feeling asset strategy, owning your home, keeping cash in the bank, avoiding market volatility, is the strategy most likely to leave you financially dependent on your wage forever. The strategy that feels dangerous, owning, equity, accepting volatility, holding through drawdowns, is the one that has historically separated those who escaped from those who did not. Part 7. The system that keeps most people in it. Now, the most uncomfortable part of this analysis: if the path to wealth through ordinary wages is theoretically accessible, why do most people not take it? This is not a question about intelligence or will. This is a question about system design. The first mechanism is liquidity pressure. Families that have zero or even negative wealth, meaning the value of their debts exceeds the value of their assets, live on the edge, just one minor economic setback away from tragedy. This is not a description of poor households. It is a description of a structural reality encompassing tens of millions of working Americans at every income level below the top quintile. When the financial margin is thin, any economic shock, a medical expense, a job loss, a car repair, eliminates it entirely. The household that was saving at the margin is now spending the savings. The compounding process is interrupted. And interrupted compounding is barely compounding at all. The second mechanism is information asymmetry. The financial system that ordinary wage earners interact with is not neutral. It is built by people who benefit from specific behaviors: spending rather than saving, taking on debt rather than equity, choosing commission-generating products over simple index instruments. The financial education most people receive in school, from parents, from popular culture, systematically underemphasizes the distinction between income and wealth, between saving and investing, between a primary residence and a productive asset. It teaches the vocabulary of wage earning. It does not teach the vocabulary of ownership. The third mechanism is time horizon compression. Wealth accumulation through equity requires patience across decades. But a household operating at the financial margin does not have a long time horizon. It has a monthly budget. The person who is 3 weeks from their next paycheck is not thinking about the 30-year compound growth rate of the equity market. They are thinking about the electricity bill. And the debt system, the consumer credit system, the mortgage system, is expert at keeping people in that 3-week horizon indefinitely. The debt of the middle class exploded from 1983 to 2007, already creating a fragile middle class. Debt is not merely a financial burden. It is a time horizon compressor. It forces short-term thinking onto people who would otherwise have the capacity for long-term strategy. And short-term thinking is the natural enemy of the one process: compounding equity ownership, that has historically separated wage dependence from financial independence. Part 8. Who paid the price? Every systemic analysis must eventually name who absorbed the cost. More tepid growth in the income of middle-class households and the reduction in the share of households in the middle-income tier led to a steep fall in the share of U.S. aggregate income held by the middle class. From 1970 to 2018, the share of aggregate income going to middle-class households fell from 62% to 43%. Over the same period, the share held by upper-income households increased from 29% to 48%. But income is only part of the story. Wealth tells the deeper one. Collectively, the wealthiest 1% held about $55 trillion in assets, roughly equal to the wealth held by the bottom 90% of Americans combined. That is not an emergency statistic from a single bad year. Household wealth is highly concentrated and becoming steadily more concentrated, according to Moody's Analytics chief economist Mark Zandi. The bottom 90%. That is not a marginal group. That is teachers, nurses, construction workers, accountants, engineers, police officers, mid-level managers, people whom popular culture would describe as successful and responsible. All of them, collectively, are watching their share of national wealth decline, not merely fail to grow, but actively decline relative to the top. In nearly every single developed market economy, the degree of stratification between the rich and everyone else is not only staggering, but is also increasing. In TIA, United States, The share of household wealth owned by the top 1% grew from 29.9% in 1989 to 35.5% in 2013. Meanwhile, the share owned by the bottom 50% shrank from 3.0% to 1.1% during the same period, from 3% to 1.1%, half of the American population, in approximately 25 years. That is not an economic accident. That is a structural outcome produced by a system operating exactly as its incentive architecture demands it operate. Part 9. Why the system cannot end any other way. At this point, there are only a few possible trajectories. The first is policy-driven redistribution, progressive wealth taxation, structural reform of retirement systems, expansion of worker ownership mechanisms. It happened before. The post-war democratization of wealth was not accidental. It was the product of deliberate institutional reform, union power, GI Bill legislation, Social Security expansion, progressive tax rates that compress the top of the distribution. It could happen again. But the political economy of such reform is formidably resistant. The groups who benefit from the current architecture are precisely the groups with the resources to defend it. The second is crisis-driven reset, a financial collapse severe enough to destroy existing asset values, forcing a repricing from a more equal base. The Great Depression was, among other things, a forced wealth reset. But resets of this kind cause catastrophic damage at every level, and the people who pay the highest price are typically the ones with the fewest resources to absorb it. The third is continuation of the current trajectory. The highest earning 20% of Americans have seen their share of wealth grow over the past 3 decades, while those who earn less saw their share decline, according to Federal Reserve data. If the incentive architecture remains intact, if equity continues to compound faster than wages, if debt continues to compress the financial margins of ordinary households, if ownership remains the primary engine of intergenerational wealth transfer, then this trajectory does not self-correct. It continues. These are the options. None of them are painless. That is the trap. Part 10. Why it matters now. The structural conditions that produce this divergence are not weakening. They are intensifying. The growing divide is being driven in part by surging stock prices, including strong gains fueled by investments in artificial intelligence. Asset prices have inflated significantly relative to wages across every major category. The price of a first home relative to median annual income has reached historical highs in most developed markets, making the initial entry into ownership, the first rung of the ladder that leads from wage dependency toward asset accumulation, more expensive in real terms than at any point since records exist. Other than income, the wealth of a family is a key indicator of its financial security. Wealth, or net worth, is the value of assets owned by a family minus outstanding debt. Accumulated over time, wealth is a source of retirement income, protects against short-term economic shocks, and provides security and social status for future generations. That last clause is the most important one. Wealth is not merely a current financial condition. It is a mechanism for transmitting position across generations. The family that owns assets passes those assets forward. The family that owns only its labor income passes forward the capacity to work. And the capacity to work, in a system that structurally undervalues labor relative to capital, is a progressively less valuable inheritance. The top 1% saw its share of household income double from 1979 to 2022, going from 9% to 18%, according to Congressional Budget Office data. Double in one lifetime, while wages for the bottom 90% grew at a fraction of that pace. The architecture that created the brief post-war middle-class expansion was dismantled. The architecture that replaced it has done something structurally different with the economy's productivity, directed a larger and larger share of it toward the owners of capital, and a smaller and smaller share toward the suppliers of labor. This is not an accident. It is not a moral failing of any individual. It is the predictable, mathematically inevitable output of a system built on a specific set of incentive structures and allowed to operate without the countervailing pressures. Labor power, redistributive taxation, mandatory ownership mechanisms that briefly interrupted it between 1940 and 1980. Ordinary wages can create stability, but wealth requires something more: ownership. Throughout history, people who converted portions of their earned income into productive assets had a greater opportunity to build compounding, transferable wealth. Those who relied entirely on labor income could work honestly for decades, while much of the economic growth around them accumulated elsewhere. This isn't simply about individual choices, it's also about the structure of the economy. Income and wealth are not the same thing. Labor and ownership are not the same thing. Until that distinction is understood and acted upon, the gap between earning a living and building lasting wealth may continue to widen.